I'm showing 9 o'clock, so let's kick off this month's edition of the Aftermath. Thank you for joining those that have jumped on with me. We do have some things to talk about despite having a government shutdown right now. And we did get a big report, even though it wasn't the one yesterday that we would normally have the day before the Aftermath. We did have a big one, and that was on September 30th when we had our grain stocks report. That was our year-end stocks number. The government tells us what we got to end the year, which means that's what we have to start the new year. You can see here the comments that they made down at the bottom that they revised the crops just slightly for corn and for soybeans last year. Not a big deal. 25 million bushels, 7.7 for beans. So not a big change there. But that's the time that they can do that if they decide to. Looking at some of the stocks numbers regarding expectations in that report on the 30th, beans really right in the middle, no big deal there. Wheat was at the top end, or right at the top end of trade expectations, pretty bearish because we added bushels to the bottom line. And then the corn was the biggie. Corn, they added over 200 million bushels to the bottom line to end the year. That was a kind of a knife in the throat, so to speak, for the market because we were not expecting anything like that. And most of us were anticipating as we came into October, we were going to see the crop size get a little bit smaller. We're seeing good corn demand, so everything was set up pretty well for a somewhat positive corn market. And then they threw this at us, and it really struck the corn market pretty hard. Now we have rebounded, and so we'll look at the charts here in just a few minutes. The other big deal, yesterday's report didn't happen. If you go to the website USDA for their WASDA report, this is what you'll find. A little bit of humor, I guess, from the administration, but nonetheless, basically making the point that with the government shutdown, we don't have any numbers. Now, that said, the rest of the trade went ahead as they normally would, as if we were going to have a report. Reuters and Bloomberg, both the news services, put out their average trade estimates. They collected surveys from 20 some different analysts. They all compile their projections or guesses on yields, production, ending stocks, and the news services put them together just like they normally would. Now, we didn't have the USDA report to check them against, but these were the average estimates. The trade came out with an average number on corn at 185. That's down from 186.7 from the USDA back in September. The bean yield at 53.2, down 0.3 of a bushel. One thing that's important, I think, is to, and I pointed this out on my report last night, is to look at the range of guesses. You've got a 4 bushel range, which is about 400 million bushels in production on corn. You've got a range of 1.7 bushel on beans, which is 136 million bushels. So the trade still is a little far apart when you look at the highs versus the lows. So I think that's kind of important. USDA has 2 more reports that they can change the yield numbers. One in November, they skip December, and then they'll get one in January. So we could still possibly have some numbers here from the government on yield here as we finish up the year. The ending stocks estimates, and we'll go into these in a little more detail in a minute from the trade. The trade expected on average corn stocks at 2.231 billion bushels. A little bit disheartening. The entire range of guesses all above 2 billion bushels. So really not a good thing for the bulls. Beans, pretty snug, and we'll look at the possibilities there at 299 million bushels. Wheat still plentiful at 875 million bushels. So let's start off looking at corn, and we'll jump straight into the balance sheets since we didn't have any production maps to look at. Back in that stocks report, USDA made some adjustments. We mentioned a minute ago. They went in and changed last year's production, 25 million bushels. The biggest change here was a big reduction in feed and residual. They called it residual. I think a lot of it's in feed because of the animal numbers we just don't have. And so they took feed and residual back down basically to where it was the year before last, which reduced total demand. Still a huge number, over 15 billion bushels, because of the huge export number. You can see here exports up over 500 million from last year. Ending stocks came up to 1532. They were in the 1.3 range. So we were looking at a pretty snug number, and now you've loosened that situation up, which again, for the bulls, not a good day. Then you look at the new crop balance sheet, and I tried to simulate the trade. What was the trade thinking to come up with their numbers? Well, we know that the average trade estimate was 185, which gives us production at 1665. We raised the beginning stock number based on the USDA stocks number. To come up with the 2231, I made a couple of changes here. I dropped feed and residual 100 million to 6 billion bushels. I still think that's way too high compared to this past year. Unless we're all of a sudden going to come up with some new animals to eat corn, I don't think we're going to sustain that 6 billion bushels. So I do think that's a potential bearish number there. I raised the export number a little bit to 2990. That's up about 35 million or so. And that gives us our 2231. That's the average trade estimate. Exports are on pace to possibly reach this number. I don't think they're likely to top it. If I were going to be a betting person, I would say that the two things that can change in November and then in January are potentially the corn yield. If we see that come down a little bit, I think that would be offset by a drop in the feed and residual demand. So it's going to be tough to get ending stocks below 2 billion bushels, which I think to get bullish corn, you've got to get that number down to 1.8, 1.7, something like that. I just don't know what's going to cause that to happen at this point. The ethanol demand is pretty well maxed out, so we don't have much growth there. So it's going to have to be on exports. And we're already forecasting such a huge number there. It's going to be difficult to see that number get bigger. So when you look at export demand, again, 2975 is what Susan had in her numbers here. So something up, I used 2990. So something up, we're looking at record numbers already. So we don't know if we can see that record get bigger, but you can see where exports are running right now. We're already throwing such a big number at the market. So as we look at the matrix, and I tried to sprinkle in some of the analyst yield estimates here, but this is what we're looking at right now with beginning stocks at 1532. Demand, I use 15970 to come up with the average trade guess on carryout of 2231. That's with 90 million harvested acres and a 185 yield. And you can see where yield has come from. USDA was 188.8 back in August, 186.7 in September. So yield has come down. You can see several of the analyst numbers here. Brock, I think, was the high end at 186 in this report. StoneX just below that, Informa just below that. On the bottom end, you had ADM Investors 184, Doan 182.7. Dr. Cordonier with Pro Farmer at 182. Now, if you follow this across at 90 million harvested acres, now you're down below 2 billion bushels. So it's going to take something like that to get the market, I think, to notice. But again, keep in mind that if we take yield down to 182, I think USDA is going to lower the feed and residual number also. So it looks to me like it's going to be very difficult to get us under 2 billion. Unless somebody like McClure is right. He's using his AI model, came out with a 178.8. And if that happens, now you got yield down below 1.7. You could even, take 300 million off of the feed number and still be below 2 billion. So one point is, I guess, we're not going to run out of corn. We're going to have a lot of corn. Stocks are going to be higher this year. The question is how much higher? And do we continue to stick a 2 in front of that number? And if we do, I think our upside is going to be limited as we go into the winter months. So looking at the world numbers now, world numbers are a little friendlier because you're seeing some huge demand growth, especially in a country like Brazil. The Brazilian ethanol industry continues to surge, and they're growing a lot of corn, and they're using a lot of it at home. And so we're seeing export business go to places that we normally don't go to, or more corn go to places we don't normally ship to because of the Brazilian demand. So this is very similar to what happened in the United States back in 2006 when we saw the blow up of the ethanol industry. We're seeing something very similar in Brazil right now. And so that's been a big, big deal for us. And So even though usage at home or ending stocks here in the U.S. are still large, at the world level, they continue to work their way down just a little bit. So that's where the positive lies. Now, if you want to root for something, we always talk about this. If Brazil has a bad corn crop this year, then all of a sudden they use all of their corn at home, and then we pretty much run the export market. And so that's why South American crops, even corn, going to continue to be important for our market here as we head into next year. So looking at the funds right now sitting short about 100,000 contracts. We will not get this updated report today. Didn't have one updated last Friday, so we're kind of shooting from the hip here a little bit, but we anticipate the funds are still short, maybe a little bit more than this now, but not a lot, still staying on this side of zero. If you look at last year, though, at this time, this is when the funds started buying. And I think that the crop got a little smaller at the end of last year. And so the funds started buying into the winter months, trying to entice corn acres. And boy, did they. We planted a huge corn acreage number last spring. But that little rally we had into spring got December corn up around 480, I think was the high. So gave us enough incentive to put some more corn acres in the ground. I don't think that's going to have to happen this year. We've got a lot of corn stocks now, so the incentive won't be as great to plant corn. But will the funds stay on the short side of the market? I guess time will tell. I don't know why they would want to get long necessarily with 2 billion bushels, so wouldn't surprise me to see them hanging zero to short some bushels here as we go forward. So here's where the market's at. A lot of lines, a lot of colors on this chart. We set our insurance price back in the spring at $4.70. You can see we never did trade above that after March 1st. We got within a half cent of it. That's a rare situation. I think it's one out of, I don't know, something in the teens or 20 years that we haven't traded above the insurance price set back in February. As of last night, we're averaging 420 so far here in October, down about 10.5%. So what does that mean? It means that, with 95% insurance or 90%, you could still see some payments made. At 85 or 80, you're going to have an individual loss on top of the price loss in order to trigger a payment. A few things to point out here. This chart gap back on July the 5th, still haven't filled that. The top end of that gap, I think, is 433 and a quarter. We jumped back into it back in September, couldn't quite get it filled. That's been a goal of mine. Good selling target, still would be if we're able to get there. Today, this morning's market, we're trading lower. Went back below the 9-day moving average. You can see this cluster of moving average lines all kind of starting to come together. And that's really typical of the corn market most years. From now till really the March contract expiration, you tend to see volatility shrink in corn. You tend to see, volume of trade start to kind of decline as you get the crop in the bins. So, and thus these moving average lines start to tighten with each other like they're starting to do now. And so you can see that, we can make lower highs, we make higher lows. This morning, key support at 415 and a quarter. That's where this 50-day moving average is. If we were to break that, then you got the October 1 low at 410 and a half. We'll see if those can hold. I do think we're going to have some harvest pressure. This is Friday morning, so we'll have some harvest pressure during the day today. May see a little bit of hedging on Monday morning. Then we just kind of go back to trading yield estimates and guessing when the government shutdown is going to end. But I really don't see a reason this market's got to get up and run anywhere. You can see the technicals, the RSI at 46, stochastics in the 40s, pretty neutral market here as we look ahead. Now, historically, if you look at the last 5 years, this is normally the time you see a bounce back in the market. So maybe that's the case. And I would love to see us have a chance to fill this chart gap before the December contract expires. That's about the third week of December. We'll see if we can do that. I think if I were a farmer, I'd probably have offers in around 425 to 430 December. Just if we start to get close to it, I want to get some corn sold. And I think that's going to be a good opportunity if and when that happens. So looking at the spreads, the carry right now, D's to July, 31 cents on the board, in addition to basis. So I know we're seeing very large cash carries in the market. One of the things we always talk about, the only true way to earn the carry is to sell it. So if you've got bin space and if you intend to carry corn, then what I would want to look at instead of selling 4.25 December corn would be to maybe hedge 455 or 460 July corn. If the market rallies and we still have the 30-cent carry from D's to July, maybe look at forward selling that. Or if you don't want to carry it all the way to July, sell May or whatever the case is at 450, 455. But look to forward sell that, because if you look at those higher prices and you say, oh, we'll get there eventually, seldom does that happen because the market knows there's a lot of corn. And I'm going to guess again this coming summer, you're going to see a lot of corn waiting to get sold unless we get a big weather rally. So kind of keep that in mind. When the market rallies, sell the carry. Looking ahead to next year, December 26th, we had our margin price at 456. I told folks this fall I wasn't that excited about locking that in. Number one, with input prices high, I'm going to guess that margins probably were not that strong. And so I wasn't that excited about locking in possibly negative margins this early. I could understand if you did, because the reason would be you just don't want to let it get away. And if the markets do decline for whatever reason, if we continue to see trade disputes and things like that, maybe there's potential downside. And you can see what the range of trade's been in the last 3 months, from 440 to 470. So 456 was basically right in the center of that. Last year, we started out at 440 in the margin price, went to 470 in February. So don't know that this year's going to mimic that necessarily or not, but I tend to not think that we've got a lot of bearishness below 456. I tend to believe that with input prices still high, that we're going to swing some acres to beans next year, both in the upper Midwest and the South, maybe even in the Corn Belt, places around the fringe of the Corn Belt. So I don't fear prices dropping a lot. That being said, if I have a chance to sell 470 corn, probably want to take a look at that. And by the way, if you look at the indicator lines, I should have this in the not zone right now. You got stochastics dipping down into single digits. So this market pretty oversold here as we head into the weekend. Switching over to soybeans. Of course, the main topic in soybeans right now is China, and the fact that we don't have any sales to China at this point. The president's expected to meet with President Xi sometime in the next, I think, 3 weeks now. Soybeans continue to be one of the topics, in addition to rare earth minerals. So there's a lot on the plate besides just soybeans. Taiwan's on the plate. So soybeans are a bargaining chip, but they're just part of the big picture here, and probably a small part of the big picture when you really look at the dollars that are involved compared to rare earth minerals and some of these other topics. So, but this is certainly for us, the big story. Now, as Susan points out, crush continues to grow here in the United States while exports are going down. This is an ongoing story. This didn't just happen because of the tariffs. Okay, this has been happening now for 5 years that exports are going down. Why? Because Brazil's growing more beans, and they continue to grow a lot of cheap beans, and China knows it. And China's been continuing to swing their export program, their import program towards Brazil. So this isn't just because of the tariffs. This has been happening. Our crush has been growing on the flip side. And then the other part of the crush, then, we're crushing beans for the oil. Our meal exports are growing. So there's a lot of things that are happening besides just the tariff issue. And I know the tariff issue is getting a lot of news on television right now. Journalists are jumping all over it. You're seeing a lot of articles right now. You're seeing a lot of interviews right now. That's just a small piece of the puzzle. And we were probably working toward a situation of China buying very few U.S. beans anyway going forward. So, and quite frankly, as you look at the balance sheet on soybeans, a carry out at 299 million bushels, we're really don't have a lot of extra beans to ship to China, quite frankly. So all things said and done, yeah, it'd be great to be shipping beans to China. Yeah, you'd love to see, stocks go down to 200 million and bean price rally. But if you ship them many beans, bean price is going to have to rally, which then is going to take us out of the market, which is going to make Brazilian beans cheaper. So, and thus they'd be shipping more beans. So I don't see that there's a whole lot here, supply demand wise, that writes a different story than where we're currently sitting now. China would most likely be buying most of its beans from Brazil, even if we didn't have tariffs on U.S. beans. But anyway, that's my soapbox speech. Looking at the numbers, USDA did raise the old crop production slightly, residual slightly, took stocks down to 316 million bushels. The trade is using a 53.2 yield, taking production down to 42.72. I dropped my export number a little bit this month to come up with their 299 number. So I think this is realistic of what's in the market right now. And so do beans have to rally? Do they have to go down? What direction do they need to go from here? 300 million is kind of that teetering point. When you get down 250 or below, you start to get snug, and then the market starts to have to ration some demand. So we're almost at that point now. So that's my 2 cents on the export thing to China is that, yeah, it'd be nice to have them in the market, certainly. But right now, the numbers really don't indicate that we have to have them in the bean market. And so a couple other charts from Susan. We're selling a lot more meal into the world market. If you look at this is world soybean imports in green. The world is importing more beans. World meal imports are up. Part of that's because the United States is creating a lot of meal. Meal is the residual now in our crush. Used to be we crush beans for the meal. Now we're crushing it for the oil. You can see meal exports. The United States meal exports at a record high right now. And so we got a lot of cheap meal. And so if you go back to the balance sheet, even though bean exports alone are down, this crush number at 25.55 resembles that extra world meal demand. And so there's a lot of different pieces to this thing that are moving around behind the scenes. It's a lot more complex than just, China's not buying U.S. beans and it's holding the bean market back. So there are some things going on right now that are positive in soybeans. It's just you don't see it necessarily on a daily basis. So what could happen going forward? Well, here's our stocks matrix in beans. We're going to start this marketing year at 316 million bushels. I'm using 4309 as demand. Right now, average trade estimate at 53.2 bushels with 80.3 million harvested acres gives us a 299 carryout. You can see the bean yield has come down slightly. Where's it going from here? I don't know. You can see we've had a few people down below the market. Brugler was the low in this last survey at 52.3. Stone X was the high at 53.9. You've got about 130 million bushel range in stocks using those two different numbers. So, but I would say if this crop gets below 53 bushel, it's probably a little supportive to the bean market because now you're digging down here around 250, 260 carryout. Can the export number come down too? I think it can. If we're not seeing China in the market, then that export number is probably too high. I think that export number assumes some beans going to China already. And so our window is starting to shrink a little bit. Now you've basically got November, December, January as our export window, and we'll see if we can get some beans sold to them and at least meet what the number is USDA has in the balance sheet. But point is, we don't have a burdensome supply of beans. In corn, we do. Beans, we don't right now. And if the yield comes down a little bit, then that makes things a little more interesting, at least here in the old crop as we go forward. Now, as you look at the world numbers, this is our reminder that we are the residual supplier to the world. Now, we need to crush more beans at home. We've been tooting that horn here for a couple of years, and crush continues to grow. That's the big positive. But U.S. production here at 118 million tons, yeah, that's great. But you look at Brazil, forecasted this coming year at 175 would be a new record. Argentina, I saw a number 47 million tons this morning, so they're forecasting a normal top type bean crop. But overall, it's all about Brazil. And if they grow 175 million tons, then we know we're going to have a lot of beans available in the world. And so as you look at, I thought this chart from Susan was pretty good as well, really comparing China bean imports to Brazil exports and how they've mimicked each other so closely over the last 25 years. So I think that's interesting. U.S. exports have just kind of floundered back and forth. Again, we're the residual exporter to the globe right now. If the world needs extra beans, they come to the United States. Brazil's beans are cheap. That's where the world is primarily going to be buying its soybeans from. Brazil exports, even though we're seasonally seeing them come down, still running at a record high the last few months. This was Karen Braun's suggestion that what's going to happen. We don't have an October report yet, but that their October number is going to be very strong because we're not shipping beans out of the United States to China yet. And if we go forward with no trade deal, you could start to see this number probably descending in the winter as it always does, but descending at a higher level. And so that's showing up on their end. You look at Chinese bean imports. I know nobody can read this, but one thing I think is interesting here is you look back to last winter, and we were seeing some very low, even somewhat historically low numbers from China. They were not importing historical amounts of beans. You look into the past year, we had some lower numbers. A year ago at this time, they were at the lowest level in several years. There were a few reasons for that. Number one, feed margins were very negative in China. The Chinese economy was not very good. They had their second bout of COVID back in 2023, and it took them a while to bounce back. And so now they have. You can see over the last few months that China has now been ramping up their bean purchases once again. So that's been a good story, kind of like Brazilian corn domestic demand is a good story. This is a good story. Doesn't matter who's selling the beans. That's a good story that they're using beans. It just so happens that right now, most of those have been coming out of Brazil. And I thought this was an interesting set of maps. I shared this in the market report the other day, showing the vessels a month ago, and then right now, still seeing a lot of boats leaving Brazil and Argentina headed towards China right now. And so that's the reality of the world trade. So beans, here's where the funds are at. They were short about 50, 60,000 contracts 2 weeks ago. I would guess that if we had this report today, it's probably going to show them a little shorter. Historically, you look at last year, funds turned buyers into the first of the year. They stayed short the market all the way into the beginning of winter. Who knows? Again, the U.S. balance sheet is not is a little tight. I do really think that the funds, though, are reacting a lot to this Chinese news or lack thereof. They're trading the news cycle more than we are, and so we'll see going forward. But shows that they're starting out here on the short side. Now, if you look at the tail of two other markets, oil has been the positive market. The funds have been long oil much of this year. Now they've sold that basically back down to zero. But in meal, they continue to hold record short positions for this time of the year. So we got a lot of cheap meal in the United States, and I think that just goes back to, supporting the meal export business. And so there's a diamond in the rough, so to speak, for the bean market. So here's the November bean chart. Been all over the place this year, up and down, up and down, up and down. You can see the channel lines. We've had a double top at around 1075. The high back in February, the high in June. We've kind of had an ascending trend line that went clear back into last year. I think at 961, then 971, then 981 low about every few months. This last low didn't quite get down to that trend line. So here this morning, the market had broken down below the 9-day moving average, which was at 1017 and 3/4. We've got this big cluster of long-term moving average lines, the 50, the 100, the 200 up here in the 1020s that continues to be a lid on this market here the last week or so. So Can you get back above that? That'd be great. Can you get back to 1050 at some point? I do think that if we get some Chinese business, then I do think this market would bounce, and I think that's the opportunity you're going to have to do some marketing here this year. Keep in mind that our window, you're expecting Brazilian beans to start hitting the export market, new crop Brazilian beans, probably sometime in mid to late February. And so our window is kind of shrinking this year a little bit. And so if we get a deal signed with China, I want to take advantage of that as a way to market beans. As you look at the insurance price, we're at 1021 as of last night. It's probably going to come down a little bit, down only 3.5%, which means that even at 95% insurance, you would also have to have an additional bushel loss to trigger any kind of a payment. So I don't anticipate many payments on beans this year unless you're in an area that had bad crops. Looking at the indicators, pretty neutral, turning lower here today. RSI at 44, stochastics in the 50-60 range. Again, pretty neutral market here at the moment. Looking at the carry, the first time in a long time, beans have got a carry out to July, 55 cents. So normally it's a pretty easy decision. You sell your beans, you hold your corn. This year. You're going to want to try to hold everything, I think. Unfortunately, I know we don't have space for it. The reason I think the carry is here is because of the lack of export demand here right now in October. So normally we would see this carry probably 30 cents, not 55. Again, we'll see if we get a trade deal done and we do boost a few exports. I think that could give a little bit of a boost to the November market relative to July, and thus chew away at the carry a little bit. So I get it why you'd want to carry beans, and we'll see if we got something happening in the next 30 days that maybe give us an opportunity to move those beans and store corn. And then finally, looking ahead to next year, we set our margin price at 1073. I was a big proponent of utilizing that program, especially the MCO program, because it was really cheap this year and because it locked in that 1073 price, and because we were nervous about the China trade deal or lack thereof, because I was assuming Brazil's going to plant a record bean acreage number this year, and I still think the United States is going to plant more beans next year. Don't know how many more, but I think we're going to see some acres flip back from corn, not because of the market, just rotationally, and then you may add a few more bean acres depending on what prices do. So we're at 1060 here this morning, so we'll see if that turns out to be a good move or not. But if you did it on MCO, you were doing it on that 9% band. If you did it on margin protection, then you're starting at 95 and going down to where your individual coverage kicked in. So you could make a strong case for that if you really wanted that 1073 to be covering more bushels for this coming year. Cotton. Didn't have any trade estimates from the report this week, or for the potential report this week. So the market's still using 3.6 as its carry out on cotton. However, I do think this export number is subject to change as we go forward, and I do think that's not going to be a good thing if it does. Now, I put together a couple of different stocks matrices here. Number one, using the current numbers, USDA is using a yield at 861, which gives us a 3.6 million bale carry out. Number two, what if we see this demand shrink by a million bales? And I think the market is thinking that's going to happen because of the lack of any China trade. And so if you do that, you basically just add a million bales under every instance here in the stocks matrix. And I think that's realistic to see that demand number, or that export demand number, go from 12 to 11 million bales, given the situation that we're in today. And so if that's the case, then all of a sudden 4.6 million bales, kind of a bearish number. And I think that that's what the trade has in mind here right now. And so if you look at this end of the year, August through July marketing, end of this past year, pretty weak numbers going to China, one of the weakest years we've ever seen. If you look at where we're at the beginning of this marketing year, it's pretty dismal right now. Shipments, nothing so far. We've had a few sales, but nothing on the books at this point. And so that's why I think the trade is every week, every 2 weeks, 3 weeks, month, this drags on. you could make a strong case that this trade situation is more bearish to cotton than it is to soybeans, because in soybeans, we don't necessarily have to have the business, a lot of business with China, given where our stocks are at. With cotton, we have to, and if we don't, then I think there's so much plugged in already that we're going to see USDA reduce that export number. So the funds are short, and over the last couple of days, I'm sure they've been sellers of more. So they're probably pressing towards that, historical record short position we had a year ago in March, 100,000 plus contracts. I would say if you had the report this afternoon, probably show them short 70, 80,000 contracts of cotton. So we'll see going forward. We're going to have a trade deal, I think, for them to get back on the buy side. So the market, we had been in this little channel for a few months. We broke through the bottom of that channel. We've tried the 9-day moving average this week, couldn't even get above it. Made a new low, 64.40, lowest we've been since back in April. The insurance price, 65 cents so far. It's only down 5.6%. You could see that drop to 64 in the next few days, given where the market's trading. So, we would still have to have a yield loss in order to trigger a revenue loss for most folks. I've been suggesting the 200-day moving average as a sales target for months now, but we continue to see it work lower. So I would still think that that's the case. And maybe if you get a trade deal signed, that would be the 100-day at 67.30, the 200-day at 68.10. Those would be some targets that I would have to make some sales. This market's very oversold. If you look at the RSI 34, stochastics in the low teens, it tells me I don't want to be a seller right now, especially given this maybe double bottom that we're forming in the chart. Hopefully that's the case, and hopefully we can get a bounce back in this market. Looking ahead to next year, the MCO price was set at 69 cents. I had several questions about locking that in. My 2 cents was I didn't think I wanted to because I didn't think 69 was really profitable at this point. And given the lack of a trade deal, I'd rather wait and see if one gets done. And if it does, then I think that gives me maybe a boost in this market with a chance to sell something with a 7 in front of it. But we do have some hurdles. We've got a bunch of this cluster of moving averages, really from 68.7 to 69.15. So that's going to be the struggle for the market if it tries to turn higher. But you are well oversold right now. Stochastics and RSI, very oversold. So hopefully the 68 level holds. If it does, maybe, again, we get a deal signed, gives us another chance to boost to the upside. And then finally in wheat, wheat did get a small grains report back on September 30th. So we do have some wheat production numbers to look at from that report. The government told us that winter wheat acres were 33.2 million planted. Harvested going to be 25.5. Winter wheat yield 54.9, the highest we've been since 2016. Winter wheat yield change from month to month. The blue states got bigger, the red states got smaller. So these will be, I think, the final yield numbers on winter wheat. And you can see the records are the ones with the pound sign: Missouri, Illinois, Michigan, with record yields this year. Texas with a record yield at 37 bushel. Again, the blue states got a little bit bigger from what they were back in August. So production, 1.4 million or billion bushels, highest we've been since clear back in 2016. So bearish to the market. What can I say? This final number was higher than all of the trade estimates going in. So again, bearish to the market. That's continuing to linger over us. Spring wheat, acres down this year, 9.99 million acres, 9.61 harvested. Yield at 51.7, down just a smidge from last year, running a little bit above trend. The bigger states, the blue, Minnesota with a record this year at 69 so far. This is not final on spring wheat, so we'll see where it shakes out. Spring wheat production, just under 500 million bushels, down a little bit from the last 2 years. So again, acres were down, so we would expect that to be the case. But the yield and production number just at the high end of trade expectations. So kind of weighing on the Minneapolis spring wheat market as well as the other markets. So as you look at the bottom line, USDA did change the ending stock number to 880 million bushels. So or excuse me, this was the average trade estimate, not the USDA number. 880 based on lower exports. So we got plenty of wheat. That's about all I can say there. As you look at the wheat stocks in this September report, keep in mind that the wheat ending year is not September 1. So, but this is the September 1 grain stocks report. So 2.84 billion bushels, the highest we've been since back in 2021. So a lot of wheat available here in the United States. This chart was kind of interesting. I showed it last month, combined wheat stocks to use across major countries. We're still worldwide running somewhat on a snug side, not quite as tight as we were a few years ago, but we've had some issues with the Russian-Ukrainian crops this year. That's been offset by a tremendous Australian wheat crop this year, one of the best they've ever had. So net, we're still not swimming in a lot of wheat at the world level, but we're just kind of okay. Funds right now, hard red winter wheat position. They are short 50,000 contracts, the most they've ever been short on this date. Oops, I got these mixed up. Let me go back and forth here. The Kansas City market with the funds short. They're, we pressed down to a new low here October 1st. We got within a few quarters of a cent of it here the last couple of days. The 9-day moving average continues to struggle. I do have this market in the not zone right now with the RSI at 38, stochastics in the teens, so it's very oversold. If you locked in your insurance price at 561 for revenue or SCO or ECO, it looks like a pretty good move to me at this point, given where the market's at. If I had to be a seller, now this is next July wheat, but if I'm looking to hedge either old or new crop, probably looking at the September peak that we had, probably also looking at the 100-day moving average now, which is down to 581. Looking back to soft wheat, very similar, but not quite as bearish as the hard chart. We're still seeing the funds very short, about 100,000 contracts, pretty close to the record we had from a couple of years back. Looking at the chart, pretty similar to Kansas City wheat, sitting here at 548 3/4 this morning. We're below the 9-day moving average. Indicators running well oversold. The insurance price looks like a pretty good deal. Again, targets, probably the September peak, and then the 100-day moving average would be some goals for the market here on Chicago wheat. And then finally, looking at spring wheat, funds are record short for this date as well right now. Not overall record short, but record for this date. And as you look at the chart on spring wheat, this is December spring wheat. We did make a new contract low yesterday. And so we'll see where we trade this morning. But RSI, down in the 30s, kind of like the other wheat markets, very oversold at the moment. So you'd seen some harvest pressure. Now that's pretty much over, but I think this market continued to struggle with the overall numbers that we're looking at. So all three wheats pretty oversold at the moment. That's about the only thing good I've got to say here. We'll see where we go as we go forward. I think the corn market's probably going to give leadership to wheat. So I would watch corn out of the corner of your eye if you're a wheat trader and kind of keep an eye on what happens there. Some of the other markets that I've had in the hots and nots in the heat check column yesterday, we had several macro trades along with feeder cattle making a new record high yesterday. Closed at 374.15, traded over 375 as a high. This, once again, I mentioned in the report yesterday, it'd be a good time to look at LRP insurance, livestock risk protection, basically a put option on your cattle. That's why it was made, for moments like this. So you're at record highs. You don't want to let the market get away from you. Go get an LRP quote. See if you can protect that price just in case we see a reversal. And the market's pretty well ripe for one. Look back to what happened just a month and a half ago. Back in late August, same thing. You had the indicators way up into overbought territory. Market set back $25 before this latest rally. So it can happen. If you got cattle to move, take a look at the LRP insurance. One of the most bearish markets we've had this year has been the U.S. dollar, but over the last week or so, the dollar has really taken off. It's called flight to safety, and I think with the government closed, two markets have really taken off. One has been the U.S. dollar. And you can see the dollar has risen back up over 99 points. And we got the stochastics and the RSI moving up into overbought territory. The other one is the gold market. Even though gold corrected yesterday, it's back up this morning about $20, $30, but traded at all-time highs this week, traded up over $4,000 an ounce. And so it was due for correction, still holding above the 9-day moving average even after yesterday's correction lower. So those two markets are the safety markets. And so with the government closure, seeing some pretty good buying in both of those. And so will it continue? Well, if the government reopens, I would anticipate, that'd be the time I'd want to be a seller in gold the day before it happens. So, but we'll see when and if that does. Oil's been struggling lately. The latest talk out of OPEC was an increase in supplies. Here as we go into the end of the year, not a big jump, but is expecting some increase. I know the United States wants to continue to increase. We want to continue to try to develop the market with Europe to buy U.S. oil products rather than buying Russian products. So I know we're going to do everything we can to keep production up. The driving season, for the most part, is over, so you're moving into that time of the year where demand is a little bit lower. If supplies are going up, demand is going down, probably a little bit bearish. So this is last night's chart. This morning we did put a 50 number in front of the oil price. So again, I would tend to think that one of the things with oil is it tends to be a leader in the other commodity markets. So especially corn, soybeans. Now corn, soybeans, both are somewhat substitutes for crude oil. So I would tend to think if oil's bearish, probably going to be something that weighs on the corn and the bean markets. And then finally, hogs. Hogs have been one of the bull markets over the last 6 months, but we've seen a huge correction in the last couple of weeks. In fact, we've gone down about $7 a hundred. And you can see now we've moved this into the not zone. I've got RSI at 37, stochastics down even into single digits. So this market was due for a correction, kind of like we saw back in July. We went down $10. Not a surprise here. We'll see if we can hold going into the weekend and maybe make another run to the upside. Demand continues to be very strong in the pork side of things. So especially with beef prices where they are. So that's been a supporting factor here. As always, my objective is not just to look at markets, but look at the other two parts of farm income as well. And so we'll talk a little bit about the farm programs right now, what's going on with SDRP, with the One Big Beautiful Bill implementation. Of course, the government shutdown does not help any of this right at the moment, but I've had several questions about 2024 PLC and ARC payments. And those typically get made in October, November of 25 for the 24 crop. So the best source out there is Kansas State University's tool. If you go to the agmanager.info, you can work your way to this. They've got all these payment maps. These are fantastic maps. And so as I click on the national map, 24-25 county ARC payments. By the way, PLC, I don't think there's any crops that's going to pay for PLC last year. I think our prices were still too high. For county ARC, here's the corn national map. Shows you which counties would pay for the ARC program. As you sprinkle into the Midwest, I realize there's maybe not a lot of people signed up in California in some places, but the East, certainly in North Carolina and the Mid-South, as you get up into Ohio, even into Eastern Indiana, there's some counties. Southeastern Illinois, you've got some counties that would have triggered. Up here in Minnesota, you've got some counties that would have triggered. So there are some scattered around the country that would trigger some ARC payments for corn this past year. You can zoom in on this map and look at your actual numbers. K-State takes the final RMA yields, plugs them in with the farm price, and does all the math for you. Pretty slick. Soybeans, a little bit bigger map here. You can see several counties around the fringe of the Midwest going to trigger some payments. So you might have some coming if you're in certain areas. Wheat, this is all wheat. Not a lot. The Northwest is primarily the areas where we see it. Again, these are on base acres, by the way, not on what you planted. It's on base acres, and these payments get made on 85% of your base acres for that particular crop. crop. That's how the programs work. And then finally for sorghum, here's what the sorghum map looks like. I can tell you that we don't have much sorghum grown in Illinois, so you can kind of ignore the green, Iowa as well. But you get out here into the plains, Texas, Oklahoma, Kansas, some of you would be welcoming a sorghum payment. But this isn't going to happen until the government reopens. Normally it happens in October, November. So something you might be looking ahead to when and if the government reopens. Looking ahead to the 25 year, which we've talked about quite a bit, USDA under the One Big Beautiful Bill raised all of these statutory reference prices for every one of these crops. They also raised the effective reference price, this 88% number. It's going to be 88% of the ARC benchmark. The ARC benchmarks didn't change. These are still 5-year Olympic averages. But the 88% instead of 85 has raised all of these effective reference prices. And so you can see some crops, you get the higher of the statutory or the effective price. So corn, soybeans are going to use the effective price. Wheat still uses the statutory price. Sorghum is going to use the effective price. Barley, rice, seed cotton, peanuts still use the effective or the statutory price. This column over here, the gray column with the blue box around it, indicates which crops would trigger PLC payments as of today. Every one of these crops would trigger a payment. The red numbers mean that the price dropped in the last USDA report back in September. The green, seed cotton, went up a little bit. Point is, every one of these numbers is below the reference price. Now, this market year average price is determined from September 1 through next August 31st. For wheat, it's till June. So we still got a long way to go to set these numbers, but what I want to show is that PLC is now in the money. And so if prices stay where they're at today, on average for the rest of the marketing year, then you're looking at PLC payments. These don't happen, though, until the fall of 26 for the 25 crop. The one thing the government did say under the Big Beautiful Bill is you get the higher of a PLC or an ARC payment. Now, ARC is going to be impacted by county yields. So if your county yields are good, even though we started with high ARC prices, that could offset the revenue. So you may not trigger an ARC payment, but with PLC right now, it looks like every crop would. So at this point, I'm just assuming that we're looking at PLC only. If for some reason you're in a county with bad yields, then we might also look at potentially triggering an ARC payment as well. But remember, the government said you get the higher of the PLC or ARC for the 25 crop year. So therefore, we're kind of looking at the PLC program. Now for 26, we're still going to have to elect a program this coming year. So we'll talk more about that as we get into the winter months, where prices look. But if you're concerned, I think most of these ARC prices are going to stay the same again for 26, which means the effective PLC price would stay the same. So that's going to give us a floor on corn at 442, market year average, beans at 1071, wheat at 635, etc. So I still lean towards PLC, given that these numbers are going to be this good for 26. I think for 27, these ARC prices are going to come down a little bit. So which means that the PLC effective price would come down too. We got a long ways to go to talk about that. But for 26, I still think these look pretty decent. And here's an example of how you calculate PLC payments in case you forget. We take your payment yield times the 85% of your base acres times the drop in the price. So in other words, for corn, I used an example here of a guy with 1,000 acres of corn and 1,000 acres of bean base, not what you plant, it's on base acres. So in this case, 442 is the effective reference price minus the market year average at 390 as of today, times my payment yield, times my 85% of my base acres, comes out to about $80,000 or $80 an acre. Same with beans, comes out to about $36 an acre. One thing I did do is put together a new tool. We don't have this out on our website yet, but it is going to be in the agent portal soon. But basically just comparing a side to side of PLC versus ARC County. So if you want to plug in some numbers and say, what if this year the price ends up at 390? Well, that 390 price is going to be the same for both. What if my county yield goes to, say, in Champaign County? What if we go to 230? Then does all the math for me. The only thing I have to plug in then is my payment yield at the FSA office. It's going to trigger, in this case, 53 cents times my payment yield times 85% of my base acres comes up with an $89,000 payment in this example. For the ARC program, if we have a 230 yield, that's going to help, that higher yield is going to offset some of the drop in the price. We'd come out to $60,000. So if you want to do a what if for 25 and say, here's where I think the county yield's going to be, and here's where I think the price is going to be, it can show you which one would pay you the most. So that was my goal. And to be able to start to do that for 26 as well, we can use this tool for that. Which one or what did the big beautiful bill mean to us by raising those effective reference prices and the other statutory prices? Well, Farm Bureau put this chart together figuring what they thought PLC and ARC program payments would have been in blue versus in orange what the enhancements to the ARC and the PLC program would mean. And you can see it's pretty significant, more than double, in some cases triple the size of the payments, because we're starting with those much higher price floors under the PLC program. So kind of interesting. What's going to happen now with trade, with the government shutdown, with China trade, the tariff deal? You can see several articles here that I've clipped that President Trump says he's going to distribute tariff money to farmers, $10 to $14 billion. This program is not going to get announced, I guess, at this point, maybe due to the government shutdown, but we're all anticipating we're going to see some tariff money that gets redistributed. Here was something that Jim Wiesmeyer with Pro Farmer, had put out this week, and what they were hearing on the Hill was the proposed payments. If we had $10 billion, if you had $14 billion, how much would the payment be? In this example here for soybeans, the big one, because of China being a bigger buyer of soybeans, $50 to $70 an acre. Here in $10 to $15 an acre in corn, wheat, 5 to 10. You can see sorghum, cotton. I would have argued that cotton probably should have been higher, but it is what it is. So this is what they're talking about. Even pork, $10 to $15 a head. Dairy, possibly getting a little bit as well. So we'll see if it happens. But this is the numbers that they were tossing around in D.C. apparently early this week. So we'll see when and if that gets announced. I don't expect any dollars to get paid until the government reopens. So at this point, we're just kind of speculating. Now, this was an interesting chart. I think StoneX put this out the other day on what it would mean for payment dollars this year. If you add this next round of potentially 10 to 15 or 10 to whatever billion dollars in supposedly coming payments, here's what it would look like total dollars for the 25 fiscal year. Of course, these other program payments down here in tan, this is the SDRP, which we're still waiting for phase 2 to get announced of that, which hasn't happened yet. That was going to be, I believe, $16 billion total. I believe $5 billion roughly has been distributed so far. So phase 2 was going to up the payments that the first round made and also include shallow loss payments in that phase 2. We don't have the details on it yet. The ECAP, I believe, is another part of this. So I believe a second part of that payment was expected to come out at some point in time. So we got a lot of things happening here. And right at the moment, the government's goal, I think, is to try to get some cash in farmers' hands. And so good, bad, indifferent, that's what's going on right now. I'm sure nobody's going to turn down a check in the mailbox. And then finally, I want to switch and spend a second on crop insurance. Where are we at today? Well, here at the end of September, we finalized setting our insurance prices in our southern states for the most part. You can see that corn ended up at $4.22, down about 9 to 10%. Sorghum down 10.82%. Cotton down almost 4% in South Texas. Rice, the big loser this year, down about 18%. So I would anticipate revenue losses on rice probably as big as any crop that we've got around the country. You can see some of the other crops, very small losses. In October, here's where we're at so far. Corn down close to 11%. Beans only down 3%. So if you had a program like ECO at 95%, you could still have a decent yield on your county corn, still maybe get a little bit of a payment. Beans, you'd have to have a yield loss in order to trigger a total 5% drop in revenue. Oil seeds actually up a little bit because of the rally in bean oil this year. Peanuts, that's carried over into peanuts as well. Rice, though, down 22%. Again, I would think rice would stand a chance to see some payments made here this year. So I want to mention our tool that we've got in our toolbox, if you want to call it that. All of our tools are in the resources tab in the agent portal. Go click on indemnity and profitability worksheets. And then down here at the bottom of the page, it's going to show you all of our calculators. I'm going to, in addition, update this. I hope to include the that PLC ARC comparison tool, maybe some other worksheets as well, but this will all be under the resources tab. But I want to focus on the SCO ECO worksheet right now. And if I wanted to click on and try to figure out some stuff here, what would ECO pay? I can do that with this. I put in the harvest price at 420. We know the base price on ECO is at 470. Take the higher of the two times my APH to come up with my expected crop value times my band of coverage gives me the dollar value of that band. If I bought 100% of it, in this case, it's going to be worth about $86 an acre in Madison County, Ohio. What I wanted to check out, the expected county yield in Madison County this year was 197.5. I plugged in different yields here in the final county yield in order to see where I would start to get a payment. And my first dollar starts to trigger at 209.7. So if we end up at 420, where the price is sitting today, then we can have a county yield 12 bushel higher than the expected county yield in Madison County and still start to trigger a payment. So that's what I wanted to see with this exercise. Page 2 of this Page 2 is our matrix. And what I wanted to look at when I filled in my matrix is, what's the highest yield I've ever had in that county? Well, if I can go into the historicals tab in our quoter, then I can look at that. Click on the historical tab, and it shows me in 2023 that the highest yield in Madison County was 214.6. And so when I put together my my matrix, I can change this percentage right here. I can't change the numbers up in the box, but I can change these percentages in order to show that 214.6. And so I like being able to see what's the worst case scenario. Well, for our payment goes, then so if I plug that in, I would have to have corn go down to 410 average to trigger a payment at that level. If we're at, like I said before, 207, 20, whatever, you start to trigger some dollars, 209. And so, but this is going to show me if I think the county yield is going to be at 201.5, then I would be looking at a $36 ECO payment. So the matrix, I think, is the best tool we've got because it's going to show you all the different possibilities. I narrow this price range on the left-hand side in as well. And as we get done with the month of October, then I can change all of these numbers to the same number because the price is set at that point. So I'm going to continue to be able to narrow this through the month as we get more and more of it set. Another worksheet I want to show you for next year, because I think this will be helpful for a lot of producers trying to figure out profitability, trying to figure out how insurance can help us be able to lock in profitability or at least limit our losses. And so we have this producer profitability worksheet and matrix to be able to show you how you can do that and how the policies are going to work for you. And on this one piece of paper, I can show a lot of things. And here's an example that I showed for McLean County, Illinois. My APH, 230. My expected county yield, 226.8. I used a base price at 456. That's what it was for MCO. And that's about where the market's at today. I said, what if I buy an 80% insurance policy on my farm, revenue protection, and then I add SCO and ECO, county band up to 95%. In the past, a lot of us have skipped the SCO. This year, it's not tied to your farm program election anymore as we go forward. Plus, the government raised the subsidy to 80% on both SCO and ECO. So I think instead of maybe going to 85% at a program that's going to be subsidized at what is it, 50%, give or take, at 85%. I can't remember the exact number, but these are going to be county coverages subsidized at 80%. Plus, they were cheaper anyway. So this is going to be I think, a way that a lot of producers can get the best of both worlds, take advantage of the higher subsidy level on your individual at 80%, and then add the county coverage 15 points at the top. I think I can get that done in the mid to low 20s in McLean County. Other places are going to be higher. I used $1,000 an acre for my expenses on my farm this year. This is the number. I think it's going to be debatable for a lot of producers. I know some guys are going to be higher if your cash rent's higher. If your cash rents are, you're not renting as much ground or you own more of your ground, your expenses may be lower. So that's going to be a big number. I can add a forward sale in here. If I forward sell 50 bushel an acre, 450 corn. I can add a PLC payment. If I think that the price of corn is going to stay, let's say, at $4, and I can do the math using my calculator and say, here's what I think PLC might pay next year. Then the matrix is going to show me all my profitability examples. And under this whole scenario, I've got all green. Now, I can take out the PLC payment if I want. A lot of us like to, and I've liked to in the past, just call that a bonus at the end of the year. If I get it, I can use that to maybe pay down debt or do something else with it. Call it cost of living, whatever. Put in a zero there. And if I did, then that's going to make some of these boxes red on here. But so I can do a lot of things with this real quickly, and just a few numbers added in, boom. The other thing I can look at here is down below, and I had to screen print this because this doesn't print out, but down below that, it breaks out each piece of this. So I've got a separate matrix for the revenue policy. I've got a separate matrix for SCO. I've got a separate matrix for ECO. So I can see how each of those pieces is going to help me. If I decided to leave the SCO blank, then all this is going to be blank if I decide not to buy it. And so then you can see where maybe you're missing some potential dollars here in this mid to shallow loss area. So I think this is a great tool. I would encourage you to look at it here in the off season this winter, when producers are starting to try to figure out what do we do for a risk management plan this coming year. How does this affect, how does using SCO maybe affect? How does using ECO at the 95%? What happens if I change my RP level from 75 to 80 to 85? Well, how does that impact? And you can do all of that with this one sheet. So coming up, we have Columbus Day on, believe it's on Monday is when we observe Columbus Day. Normally, the markets are open. The FSA office is closed this year. FSA office is going to be closed anyway, so that's not going to be a big deal. Our insurance pricing continues through the end of the month for many states. We'll have our next potential WASDA report on the 10th of November. We'll see if the government's reopened by then. We'll talk all about it in the aftermath on the 11th. We have Thanksgiving on the 27th, and then you can see the other reports and holidays as we go into the end of the year. So with that, I appreciate you listening to this month's Aftermath. Thanks for joining, and we'll talk to you again very soon.